Hi guys, welcome to Your Property Network and Chatting Property with Ant and Alex. I'm Ant Lyons, founder of Your Property Network, and I know that loads of people will be watching this or listening to this who may be familiar with my co-host today, Alex. Alex is the editor of Your Property Network, so he pulls the magazine together and organises all the online content and is a property investor himself. And today we're talking about mistakes that we all make in property investing, many people make when they come in new, and mistakes that we've made along the way as well. So hopefully you're here to learn and dodge some of those mistakes that we've made along the way. So, hey Alex, thanks for joining me.
Hi, good to be here.
So should we do a little potted history in property for both of us, for people who are completely new to this? So I've been a property investor and a landlord for just over 20 years now. And I started just prior to the credit crunch, for those of you who are old enough to remember that, way back in 2008. And back then I was buying property in a certain way. I could kind of buy property, no money down, remortgage the same day. And if I did it well, I ended up with a property that had equity in it from day one. And if I did it really well, it was also cash flowing from day one. And then the credit crunch came along. And all of that changed for me. And actually what really happened is my deals got better. I had to buy, add value, force the appreciation of the asset, and then refinance later on. And I'd end up with a property that had equity in it and then was making me a healthy cash flow each month. All the kind of bank controls, all the lending controls were different then. Their lending criteria a lot more strict, and actually that made my deals better. So when a lot of people were exiting the market way back then in 2008, actually I was buying more property because it was better. And then from then, I kind of transitioned into saying, well, actually I've got quite good at buying these single-let properties, quite often flats down here in the southwest of the UK. And some of those I was turning from one-bed flats to two-bed flats and renting them out. And then I started doing blocks of those. So maybe 2 flats in one block or a block of 4 flats. And that was great because it was a little bit more work for 4 flats in one block, but it wasn't 4 times the work. So I could spend about the same amount of time on it and actually end up with 4 properties rather than 1. So it kind of sped things up. And then I transitioned into development, and I started taking on commercial buildings and then converting them, sometimes listed buildings, converting them to residential. And that was great and also hugely challenging. And I took a huge step out of my comfort zone, but was fortunate to be surrounded and working in those deals with some amazing people. And that's kind of where the space that I operate now, as well as obviously with yourself, Alex, running Your Property Network and some other business interests I've got as well. So life is busy, and I'm a family man as well. So it never seems to be enough time in the day for everything. So now, Alex, you definitely started later than me because there's a bit of an age gap.
There is. If the camera quality is not quite good enough for everyone, you can see there's a few less wrinkles on my forehead and a few less grey hairs on the top of my head than with Ant. Yeah, I'm on very much the opposite end of the spectrum, but still very much a property guy. So I got started in property in my early 20s. Having gone through university, and I ended up kind of working all the way through university, and left that, joined a marketing agency, and did that for about I think I survived about 9 months in that before I said no, that's it. I want more freedom. I want to focus on art and athletics at the time. I want to focus on that, and yeah, I went self-employed, and I was fortunate that went quite well. And whilst living cheaply, well within my means, being self-employed, I was able to shove a decent amount of money into property. Nothing crazy, but I was able to shove a decent amount of money into property. Kind of started with your single lets and your HMOs, and kind of oscillated between, okay, actually, is this the best strategy? Is this the best strategy? and have kind of got general principles now of what I invest with, which we can kind of chat through. But I've tried a few things, haven't made it into the full development world yet, but hopefully into the future. And I guess that's quite a cool thing about what we're doing today is that we're both in very different stages in our property journey. I'll be catching Ant. Don't you worry, I'll be catching Ant. But yeah, we have two different perspectives, and yeah, outside of the actual doing of property, I've got what has got to be one of the coolest things, and I think probably people are very envious of that because this is the kind of stuff I get to do. I get to talk about property with other property people, and hopefully help people like yourselves get if it's just one step further on your journey, then we've done something. Yeah, we've done something right today, I think. And I think for me, that's what we want to turn this podcast into, something that, if someone can click on and it's a 25-minute episode, and if you get one thing, and we don't need you to get 10 things, if you can get one thing from it that helps one part of your property business, whether that's helping you make a step to start, whether that's helping you stop making a mistake, because let's not forget that in property, mistakes aren't hundreds of pounds, mistakes are thousands of pounds. Or if that helps you scale to the next level, then yeah, we've done a pretty good job, and we'll take it. Yeah. What are you doing? Let's catch up for anyone make this kind of a couple minutes. What are you doing in property at the moment, Ant? Because we've not actually spoken about our own property stuff. What are you doing at the moment in property, or are you in a kind of a frozen state?
Yeah, I've been taking stock for a little while, but I have a project that is kind of going through at the moment. So I'm buying. I'm actually using a lease option to purchase some derelict barns. So, whilst we have the option on that, we'll go through planning, and actually the intention of that, it's a very rural location, is that will be developed. It'll be a fairly large development into holiday lets. So that's what I'm doing right now. It took me a long time to negotiate with the owners on that. Things didn't move quickly. I had quite a few legal fees in there, but I'm really, really pleased with how that's going. So we're just actually appointing architects at the moment and planning consultants on that one. So yeah, that one's a passion project as well as a profits project. So
Well, I think a barn conversion, a barn renovation. That sounds pretty good. Sounds pretty good to
well,
me.
it should be probably 7 or 8 holiday lets when we're done. So
That'd be cool. Well, at least we know where I'm going on holiday for the next few years. Then we'll mark it here. That way, it's signed off in blood that I'm able to come down there and enjoy myself down in the barn. We'll obviously do work. Don't worry. We'll obviously do some work whilst we're down there.
and
Cool.
what about you,
I've got
Ant?
a
What's the focus for you?
Yeah, I've got a refinance going through at the moment. I think I mentioned it in last month's YPN magazine, and I had it, and I almost say I've had a down valuation, but actually, does a down valuation even really exist? Maybe it's a fair valuation. I got slightly less than I thought, and actually there was justification for the value that I put. There was justification for that, and there was plenty of justification. There was also justification for the value that the valuer put, and I guess there's always the value is always going to go for the softer option, and it protects them, but it means I pull a little bit less money out. But yeah, I almost said almost a down valuation, but I'm not sure if they exist.
Yeah, who knows? That's a difficult one, isn't it? I've tried to argue values with valuers myself before in the past, and I'm not always completely convinced I'm in the right. So
Yeah.
yeah.
When there's so much bias involved, it's pretty hard to be objective about it. Cool. Well, look, let's go on and start talking about mistakes. Obviously, as we mentioned, we've kind of had different amounts, different journey times, and a different journey throughout that. But actually, mistakes are probably pretty universal. What was Give us one from your side, and let's talk through that.
Okay, sure. So, and probably over the last 17 years of being at the helm of YPN, of your property network, I've interviewed maybe 2,000 property investors and met many thousands more. And so the mistakes that are made, not just mine, these are kind of distilled from the many, many conversations that we have with people who are in property and landlords around the UK. So let's talk about buying buying properties for the wrong reason, not buying for cash flow. Okay, I think this is a really important one. And I see this a lot, particularly in expensive areas of the UK. People are save up, they work really hard, or they inherit some money and they get a lump of money and they decide to buy a property, they decide to buy an investment property. They know it's a good vehicle for kind of wealth, but they are concentrating just on capital growth. And this was probably me, actually, way back in the day. I would have bought a property if it made 50 quid a month profit, if my rent that was coming in was 50 quid a month more than my mortgage going out. And actually, that's a massive mistake, because one boiler goes wrong and you've kind of wiped out 3 years worth of profit from that thing. And also, we have no control over capital appreciation. We buy into the fact that over the long term property values go up and property is a sound investment for that very reason. But you and I can't control that. Nobody can control that. Can the government control that? Probably not. These things happen. So I met someone at an event in London a few years ago, and she told me that she bought 2 properties and put down, I think, like 50 or 75 grand on each one, and she was subsidising those properties each month to kind of maintain them. And what she really wanted to do was to actually step away from her day job and be kind of financially free through property. But she was just about to buy another one of these, and it was going to take her further away from that end goal. So it can be really tempting to say, well, I'm buying in an area of really strong capital appreciation, and so I'll forego the cash flow on it. But that's a mistake. So for me, single let properties that I own, that maybe I would buy now for, like, let's say 75 grand, something like that, for a 1-bed flat that I convert to a 2-bed, that's got to put money in my bank account every month. And that's got to be a minimum of 200, really £300 a month profit over and above the letting agent's costs, the mortgage costs, those kind of things. So I don't know, I guess you've seen people do the same thing.
Yeah, not only can we not control it, the capital appreciation, what we certainly can't do is predict it. There's been a classic, you invest down south for capital appreciation, you invest up north for cash flow. And I think maybe that was right 10 years ago, and maybe it was right 6 years ago. But you only need to, I look at the Zoopla reports where they report on each area of the UK, and for years that hasn't been the case, that actually capital appreciation is going further up north, because people get priced out. People get priced out of London, they get priced out of Bristol, they get priced out of, these Exeter, these expensive areas that have done really, really well. And so we can't even sit there and say with any certainty, this area is going to provide capital growth. And yeah, it probably will, but to what rate, we don't know. And why bank, in that case, 75 grand worth of deposit on that? Why risk that? For me, that comes down to those investing principles of always cash flow. I definitely want capital appreciation, and I will research an area and try and establish whether I think that's going to happen. But I'm never relying on that. I'm relying on, I can't predict capital appreciation. What I can predict with a very good degree of accuracy is what my cash flow is each month, right from the start. And yeah, I'll take that. But I completely see that happening, and I see this mainly in the hobby landlords. And I use the word hobby landlords not as an insult at all, but it's the kind of, I've got a bit of money. I don't necessarily want to be a portfolio landlord. I think this is a good thing to do. Put a bit of money into property. I maybe not be set up right in the right limited company structure or whatever that is. And yeah, it's a dangerous place to be, because you can't be subsidizing your investments. That doesn't work, especially if your goal is financial freedom. It does, like you say, and it does the complete opposite. So I've since day one, I've always invested for cash flow, and have done very well on capital appreciation off the back of it. But I've always invested for cash flow.
Okay, brilliant. So rule number 1, invest for cash flow. Yeah, okay, that's what we're saying. Don't make that mistake. And this ties in with the second mistake that a lot of people coming into this make, because people have got a chunk of money, whatever that might be, and they're really keen to get started in property, and they buy a property, maybe the wrong property, and that money is stuck in that deal. So they put their deposit in, and then what? They've kind of run out of money, maybe after one, maybe after two deals, maybe after 10 deals, depending how much money you're starting with. But they can't scale up. They can't continue to grow that portfolio unless they get the capital appreciation, which we've both said is very, very difficult to predict and certainly impossible to control. So I know this is something you feel quite strongly about, isn't it? It is not ending up with your money stuck in a deal.
Absolutely. So, and just to say this, I'm not all about the kind of no money out deals. These are things that I do I perfect. But just being able to recycle a good chunk of that money, this was something. So this is kind of what we classify as BRRR, right? Now I always say there's like a slow BRRR where
Let's
you
just
would
explain what that means for people who've
yeah,
not heard the term.
absolutely. So B, buy, refurbish, refinance, rent out, and then you want to add an extra R on that's rent. And essentially, it means that you buy a property that's been a little bit run down, you put some money into it, you renovate it, you raise the value of it. So let's take £100,000 house. You raise the value of that by putting in 15 grand, but you raise it to, I don't know, £150,000. The new value is 150,000. Now you can refinance that and you can pull out some money. So you refinance that back down to 25% equity, whereas actually currently now your equity is sitting a lot more. It could be sitting in, it could be £80,000 worth of equity now. So you pull out your money and you go back down to 25% equity in it as the 160, and you're able then to have that cash in your bank account. It's a loan from the lender, so it's tax free, and it sits there ready to be used again. And it allows people to scale. Now, when I started in property, I didn't know about that. I didn't know about the terminology for it. I just knew that I wanted to do a bit of a renovation. So I kind of discovered it by doing or discovered it for myself. Just clarify, I did not coin this term. Discovered it for myself by doing a very small renovation on a property, and then 2 years later down the line, I had a revaluation. So I bought a property for 115. I think it was 115,950, and put in, I think it must have been about 6,000. Now this has been in YPN, so I have a look at the numbers. I think it must have been about 6,000. 2 years later, it was worth 160,000 off a very smart but small scale renovation that I probably did a bit too much of myself, which we'll definitely cover. And I valued at 160,000, which means that by the time I pulled my money back out, I got given back my entire deposit and more in 2 years. Which some people will do this in 6 months. I did it in 2 years. I was happy with that. But yes, I'm very passionate about adding value to properties, which I guess is what this point is about. The other really good thing about adding value is that you bake in equity not only to go aggressive and buy more. So I bought another property off the back of this, but you also have an ability to fall back on that. Let's say the market takes a 5% hit. Well, okay, I'd rather have a 5% come off that much bigger figure because I've already baked in a bunch of equity than go into risk going down further on a lower figure if my equity was only smaller. So yeah, I think it's one of my principles of investing is I always need to be able to add equity with the very small caveat of if I'm getting something below market value, then maybe I won't need to as much. But yeah, it's one of my big principles that I always invest with now.
Okay, and of the many hundreds or thousands of people I've met and interviewed over the years who own a portfolio of, let's say, 5, 10, 20, 50 properties, 200 properties, whatever the number is, I would say every single one of those people have followed that principle. Buy fairly aggressively below market value if possible, or as keen a price as they can, with the idea of adding as much value as they can for the minimum spend, because we need to control the spend, and being able to refinance and go again. Almost nobody, probably nobody that I've met has just had enough money to buy 50 properties.
And that's the thing. If you come from that position of being able to just say, yeah, well, I've got X amount, I'll just buy 50 properties. I don't need to add value. Then fair, do that because that's a much easier way of doing it. But yourself, myself, we're just normal people. We're sadly not ex-football players, and and we're not. We've not exited these big businesses, which have meant that we've had just tons of money at our disposal. We've had to make every single pound work, and this is the way you scale with that. But if you're in a position, if you're watching this, reading this, and you're in a position where you've got tons of money, then just ignore what we're saying right now. But most of us aren't going to be like that because most of us aren't billionaires from the start. Yeah, I think when we talk about that, which this kind of leads into one of my other kind of key learnings when we talk about that first deal that I did, the one that went from 115,000 to 160,000. I made a very good learning thing for me was that I tried to do as much of the work myself as possible. But at that time, I was running a marketing agency. I was also doing my athletics, which, was as close to a full-time thing as I think you could be without being on British Athletics funding. And what it meant was that I was going up on weekends, or I was going up on a spare Tuesday afternoon, or I was going up on that. And it meant I dragged out that renovation, which was not a big renovation. I dragged out that renovation and going up to sand to sand a door frame and the skirting boards in one room, and then drove back down 45 minutes. And by the time I'd driven up there, it took. Every time I'd driven up there, done all that, it took weeks and weeks and weeks. Now I've got a painter who, and I use the painting example because that's a very clear thing that I think a lot of people think that they can do and they can paint. And yeah, of course I'll paint that myself and save myself 1.2 grand. My painter, will charge me to do a property like that. Yeah, you can save that money, 1.2k, which is a lot of money. Don't get me wrong, it's a lot of money, but you can save that, or you can invest that in someone doing it in 2 days, getting that rent in and 900 quid a month rent, versus dragging it out on weeks on end. So yeah, one of the big learnings for me on that particular renovation was that you don't always need to try and save money. Actually, sometimes saving money is costing you money.
Yeah, that's interesting. And when we talk about, trying to do everything ourselves, I've definitely been guilty of that. I've had me, my wife, family members all stood around a house I own, with paintbrushes and, enlisting everyone's help and making them bacon sandwiches for the day, and actually completely false economy. None of us were great painters either. So the other bit I kind of probably realised quite quickly was that self-managing properties wasn't for me. I think I did okay when I started out, but it was something that I really didn't enjoy. I didn't really enjoy kind of getting the call outs from tenants when things went wrong. I wasn't amazing at the admin side of things, the gas safety certificates and all those kind of bits and pieces that have to happen, legal requirements, compliance stuff. It wasn't my skill set, it wasn't my strength. I did it just about. And I remember getting a phone call from one of my tenants on New Year's Day, and they could smell gas at the property. And so I went there, and I was thinking, what do I know about this? I don't know how to deal with this at all. I've sort of gone there, with probably a slight hangover on New Year's Day, early in the morning, and just thinking, you know what, this isn't for me. So then I moved into kind of using agents. They were a lot better at it than me. They were better at tenant referencing. I didn't end up with terrible tenants, which I've had some of before in the past. They were great at the admin side of things. They were fully systemized at managing 200-300 properties with a whole team to do it. They were just better than me. And I was probably getting higher rents as well, interestingly. So for me, that was, again, it was a false economy, trying to save some money, but actually doing something I was poor at. And then I could hand them across to agents and say, do you know what? Now my kind of property portfolio would take me an hour a month or something, checking that rents are in and just responding to a few emails, rather than chasing up handymen, trying to coordinate that with a tenant to make sure they were there at the same time, and doing a terrible job, and handyman wouldn't turn up, tenant spent the day in there waiting for them. It was a pain in the backside. So yeah, that for me. And I think there's a natural progression there. I think people start self-managing and then maybe they employ agents because they don't they realise maybe they've got a job as well, and they just don't have the time to do this well. But you think also there might be a second evolution to that as well. That
Yeah, we spoke about this. We spoke about this before, and I was saying that it's going to vary person to person. Who wants to do what is going to be probably the most important thing. Some people have, the reality is that let's not avoid this. A bad agent is very, very bad for your business, because what they definitely don't do is care about your property as much as you do. But maybe there is we kind of touched on this earlier, before this call. Maybe there is a cycle that happens, and I don't know. I'm hypothesizing here, but a someone in their 9 to 5, they can't afford to at the start of their property business, they can't afford to bring an agent in because cash flow is the most important thing right now. Maybe they start out and they start managing their properties, and then they get to maybe 5, 6 properties, and it starts to say, okay, actually now I can afford to bring in an agent, and they're going to be hopefully better at what they do. Find the right agent, of course, if they're better at what they do, and then I can still focus on my 9 to 5 and getting that seed money. But then maybe it comes back around for some people. Some people won't. Some people where they go, okay, actually now I'm full-time property. I can afford to take back the properties, and maybe it would take me an hour a week per property to manage that. But I can afford to do that now because I've won back my my 9 to 5, and part of that is I can actually save myself thousands by taking back management. And then maybe they go on and they bring on a member of staff as they grow and get bigger and bigger to do that rather than outsourcing. But finding a really good agent is sets you up perfectly. I've just started, so I've been self-managing all of the years until right now, and I've just my first property has been handed over, which is as in a HMO, and I'm looking to move another HMO over to an agent who's actually been on YPN. It's Mark Topham at Top Marks in Mansfield, so it's just within his kind of catchment area. So we're meeting next week to discuss that. But yeah, I'm starting to move things over as I start to do more and more with YPN, and just things start to move in a different direction where maybe I don't need to manage as much, and I don't need to keep an eye on that exact pennies coming out.
So let's talk about another mistake that people make, and there's two different takes on this as well, and that's not charging the right amount of rent. So, or getting that a little bit wrong. So we were talking earlier on, and you were explaining examples of when we haven't got the rent at the right level to start with. So talk us through that.
Yeah. Okay. So let's let me start with kind of my overall philosophy on this, which is something that I've written down and I've kind of always referred to, and I tell people about this when kind of having these conversations, whether it's coaching calls or whether it's YPN and whatever. I always say that void periods are more expensive than slightly less rent. Bad tenants are more expensive than everything. And now what I mean by that is that some people will get a property that's empty and they'll get really excited because the general market area is, let's call it £900 a month. That's kind of what the property can command. But with a little bit of extra work, why not? Why don't we push it to 975? It's £75 a month extra in your pocket. And maybe it will rent out for that. Maybe it will rent out for 975. But if it takes you 2 months to get to 975, rather than having it at 900 or maybe even 875, and do the maths on that. Do the maths on that. That the actual payback of having 2 months empty and having more rent from it is going to be years. Might as well just get people in early. And again, with that, it comes up to the second part of that kind of philosophy that bad tenants are more expensive than everything. That a bad tenant at 975 is going to cost you a hell of a lot more than a very good tenant at 875. So if you get a bad tenant at 975 that takes 2 months to come in, then you've compounded bad with bad. It's something that I've learned over the years, and yeah, wrote it down somewhat poetically, and I always like to bring it up at any given opportunity. I'm very boring at dinner parties.
Well, we definitely want to make sure our properties let fast, don't we? And I've made mistakes in terms of charging the amount of rent in a different way as well. So I've had properties where I've had tenants in there for like 15 years or more, and over that time, interest rates were low at the time, and my tenants weren't hugely well off, and so I just kind of stuck at like renting it whatever they'd moved in at kind of 15 years prior. So that might have been, let's say, £500 a month for one property in particular, as I was thinking about. And then over the time, I didn't increase that rent. I just kept it as it was because things were going okay and I didn't want to upset staff. I didn't want them to move out because then it would have been expensive. I'd have to renovate the property. I've had a void period. So I just kind of kept it as it was. And then what happened is interest rates went up and I was on a variable mortgage. And so all of a sudden I'm looking at my property going, well, I've been making like 300 quid a month on this. And now I'm kind of breaking even. Had I kept in line with market rents, the market rent was probably 875 quid a month for that property. And I'd been a bit lax about it. I couldn't then just lump another 375 quid a month onto my tenant. There's no way they could afford that jump. They would have definitely been moving out. And in fact, that's what happened. They did move out. What I should have done in retrospect is just increase the rent on an annual basis in line with market rents or in line with inflation at a fair and reasonable rate, maybe sort of even just 25 quid a year, kind of increasing that rent would have probably got me there over that period of time. And instead I ended up with a property that was month to month while they were in there wasn't really making me any money, and then I needed to charge the market rent but they couldn't afford it. It was too big a jump at that point. So I definitely made that mistake, and I would urge anyone who's doing this thing. You don't want to be overcharging your tenants. They need to be able to afford it. We want to keep our tenants in there. They're our customers. They do an amazing job, hopefully, of looking after our properties and covering the cost of that and making us a profit. But at the same time, let's not subsidise for them to live there because we get it a little bit wrong. So yeah, that was
Absolutely. No,
definitely a mistake I made.
I completely agree with that. And I've kind of over the years, again, interviewing people, a lot of the big landlords have spoken about how they review rents annually, and often landlords will talk about how they mention that to tenants at the start when they're doing their viewings. Just so you know that I tend to trail each year just behind market rent. I want to reflect that you guys are good tenants and keep things below, but I don't. But it needs to go up. It needs to go up to keep it to keep it kind of working. The funny thing is so just pulling up reading that kind of previous little thing that I mentioned, the second one on my list of kind of philosophies that I've been, so to give people context this, I've been writing a bit of a kind of philosophies to invest by, and just as a bit of fun, kind of slightly poetic stuff, not that poetic but slightly worded prettier. The second one is don't raise rents and complain about rising costs to a tenant while sitting in a Ferrari outside their house. And yes, so when having these conversations, there is also just make sure that you're not coming in complaining about how you're making no money from this whilst sitting in a big red thing outside. Yeah,
no one's going to feel sympathy for you at that point. So.
Absolutely not. But no, I think you're absolutely right. Keeping in touch with rents to make it manageable for everyone, because it needs to make sense for you to be able to then offer a good service to tenants. The other big thing I think that, and I come back down to one of the things I mentioned earlier in terms of hobby landlords, and I'm sure you were in the same position as this, and I was also in the same position as this, was not taking advantage of the right right kind of tax situations where maybe you bring in an accountant who's a general accountant and they're not a property accountant, and they don't they cover things quite well, but where are the savings? And I remember it was years I was investing for years and then in business for years before I heard about trivial benefits and things like that, where you can have, these £50, £50 trivial benefits, or summer and Christmas parties. Now, I'm absolutely not an accountant, a tax accountant, so don't take anything I'm saying as tax advice. But having spoken with them and okay, so there's whatever it is, £250 for Christmas party, and whatever it is, £250 for summer party. Well, why have I got 6 years into this thing that we call business before I found out about that? And I think there's so many things there that if you have, I guess, the right people around you in an area that, like, you don't understand, and you're not an accountant, you'll never understand it like that. I'm not an accountant, I'll never understand it to that degree. You have to have the right people around, with the right information that can help you save money. It's one of the biggest things, because you can make all this money. In fact, now, can we put in? So we did. And I can't remember when this was. This was months ago now. I'm thinking on the fly. We did a tax ebook on this. Can we put that? That's a pretty please from myself and everyone else, everyone who's reading and watching. Can we have that as a thing that anyone can download from that?
Yeah, let's make sure that we get a link in the description here that takes someone to that. So that was the tax guide for residential landlords that we created with one of the UK's leading specialists in property taxation. So we'll make sure we get a link in the description here where someone can go on and download that. You would be crazy not to. I personally, I think we should all pay tax. And I'm happy to pay my share. I don't want to pay more than I have to. I'm constantly amazed by the number of landlords that I meet, or kind of, as you say, hobby landlords, hobby investors who are trying to do their accounts themselves, or maybe they've got a bookkeeper to file the accounts for them, but they're not actually taking any tax advice there at all. They're not kind of using any kind of spousal benefits or partnerships there to use up tax allowances. They just haven't thought about it. They just don't know these things. They don't know whether or not they can claim for a kind of home office allowance or anything like that. So, all these things, and they add up, a few £100s at a time or a few £1,000s at a time. They really, really add up, and they make a big difference when in July and January we make those payments to HMRC. Now, neither Alex or I are tax advisors, definitely not. You need the right team, the right professionals in place. And if your tax accountant is not saving you more money than they're costing you to do your accounts, then you've definitely got the wrong tax accountant there.
That's probably the benchmark, isn't it? Is bringing someone in that's going to save you more than they're costing you. I like that. So yeah, it's a good way of putting it. So yeah, let's even if you guys who have watched and listened to this, even if you got nothing from it and you thought, oh God, these guys are dead awful, then at least hopefully there's one thing in there that saves you, whether that's hundreds or whether that's thousands or whether it's 50 quid. So yeah, let's get that in the description. Let's get that as a free download for anyone who wants it, and hopefully that listening to this has been has been solid and actually profitable for you. I think if you can invest, what are we now, 37 minutes, if you can invest 40 minutes of your day and we save you even from that, yeah, a couple hundred quid, then yeah, I'd do that.
Absolutely. And let's just give a resource for people to click onto as well if they want to find out a little bit more about who we are and what we do. So since 2008, Your Property Network has been the UK's leading magazine and membership site for active UK property investors, people who are in property or looking to get into property, where we share knowledge, experience, strategies, real life deals from UK property investors from our community, where people can look at those deals, understand how they were put together, understand how the finance was raised, maybe how the refinance was done. This is all about creative property investing. We genuinely believe that anybody can achieve in property. Anybody can make this work. Not everybody will, obviously. It takes some grit and determination along the way, and the right skill set and the right knowledge, and surrounding yourself with social media proof of other people doing this. So if you hop onto yourpropertynetwork.co.uk, you can find out all about our low-cost membership there and get a free trial there. And we'll make sure that in the description of this, there is a link where you can download the tax guide, the ebook guide to residential property investing. tax savings for residential property landlords. So thanks for joining us, and we look forward to catching up with you on the next episode.
It's been a pleasure, Ant.